So today I wanted to wrap up, I guess, a three-part series on cancellations. So we went over canceling listings, we went over ways a seller can cancel, and today we're going to do how a buyer can cancel a purchase. Um, these are probably the most common ones we see, and there are quite a few happening right now. I think the numbers are pretty high on cancellations just across the board, listing cancellations and, sellers trying to cancel and buyers canceling and getting cold feet and stuff like that. So that's why I wanted to go over these because it is important to do them properly to avoid, post-closing issues and having to go to mediation and things like that. So that's why I wanted to do this three-part series. So today we'll wrap it up with buyers canceling, and then we'll also go over liquidated damages clause a little bit, just some basics on that. So, but before we get started, we have Paul with Try and True Home Loans. Give us our mortgage update today. How you doing, Paul?
I'm good. I'm good. Thank you very much. Hey, everybody. It's just kind of want to throw it out there. Tried and True Home Loans is owned by Rice Realty. So we are definitely one big family. Before I get started, wanted to let you know that I understand if you have a lender that you're married to, it's okay. If you just want to pick up the phone or text me about some questions, about some second thoughts, please feel free to do so. If I don't have the answers, I will get them for you. Okay. All right, let me just share my screen. Uh, um, can you guys see my screen?
Yep, I can see it.
Okay, whatever. Okay, U.S. mortgage market update. Okay, key update. Existing U.S. home sales rose in July as mortgage rates eased and price growth slowed. 30-year mortgage rates hold steady average, as an average, 6.58, the lowest since last year. Don't get too excited. This could be just because this is a wild week, the wild next 8 weeks that we're going to see on the level of Feds, what they're going to do with lowering the rates, raising the rates, or keeping it the way it is. Just don't get too excited. Just pay close attention to it. The best thing that you could do is get educated. Okay, mortgage rate snapshot. 4-week decline to the lowest point, like I said, since last year. And if you look on the right side, you'll see the graph, over time, over so many years, if you compare today to, we've already talked about it since 1980. Your grandparents, your mom and dad, maybe they had an 18% rate, but at that time, homes were $30,000, 40,000, maybe 50, price of a car, whatever. But again, rates are remain to expect remain stable unless, like I said, it's going to get changed. There could be a lot of different shifting going on. Keep an eye on the news, the difference between an opinion and a fact. Stick with the fact. The opinion is only going to drive your emotions up and down. So try to stick with the fact, and see what's going on. Okay, housing market trend. July saw a rebound in previously occupied home sales. Like I said, this is more of an average. Every city, Texas, California could be different. Easy mortgage rates and slower home price growth contributed to the increase. Improved affordability could boost buyer activity in coming months. Okay, buyers are saying peekaboo, hey, this might be our favor. Some people might be excited, some people might be forced to buy due to maybe 1031 exchange or a relocation. Okay, lower rates may improve affordability for buyers. That's a huge question mark. I still feel that we have a long way to go to where many people may have opinions. Hey, I want the rates to go lower, or hey, the housing needs to be lower in terms of um, the sales of housing. You can talk all day you want, but the economy is going to drive it. Okay, market remains sensitive to economic and data and Fed decisions. Political development could influence market of mortgages and housing. If you got any questions, if you want to talk more about rates, talk about program, there are still more programs available out there. Don't feel that just because somebody made an opinion, oh my God, we're gonna crash. Hey, that's just an opinion. Stick with the fact, stick with what's going on today in the mortgage market or real estate market, and just roll with it. That's all I have to say. Thank you very much, everybody.
All right, thanks a lot. Yeah, uh, the Fed didn't meet necessarily last week, but they gave an indication that there's going to be a drop in September. And so I think it was Thursday and Friday, we had some pretty good rate improvement on, just across the board. So, um, will it continue this week? Potentially, I think we're probably going to be a little flat this week. But before we get too excited, yeah, I think we're in this market for several months, probably through maybe even next spring, until we see a real turnaround. I think we need to get down probably into the 5.5s or something like that before we really start seeing the buyers coming out, in bigger droves. So, but applications I bet will pick up this week. They probably picked up a little bit last week. So if you have somebody who's been thinking about it, or maybe they're in escrow right now, they might be looking to maybe lock this week. It might be some good timing. So, all right. Oh man, he wants an example of a rate buy down scenario. Yeah, we'll have to do that. So, let me share my screen. Okay, so last of the three-part series. So, um, we are doing mastering cancellations or contract cancellations. Today is how a buyer can cancel a purchase. So, like I said at the beginning of the meeting, so far we've gone over listing cancellations and we've gone over how a seller can cancel a purchase. Today we're going to go over how a buyer can cancel a purchase. And you may ask, why are we going over buyer cancellations? It seems like they can always cancel very easily. And this is somewhat true, but they can be challenged. And so that's why, and that's what leads to disputes. That's what would lead to an earnest money dispute where a seller says, you know what, I don't think that that cancellation was done in good faith, and I'm going to challenge it and dispute it. Um, and so we want to make sure that when we're doing these cancellations, that we're being thorough with them. We take our time and we cancel for the right reasons. So, and also that we're canceling in good faith to avoid disputes with the earnest money. Because as I've stated previously, when you're looking at that cancellation form, the cancellation of contract form, it's two parts. First part is who is canceling and for what reason. And that is just a one party signature. It's a unilateral cancellation. The second part is the disposition of the earnest money. So um, that's where things get a little sticky sometimes, and why you want to make sure you have a solid cancellation, whether you're on the listing side or on the buyer side, so that if this were to go to be disputed and you need to go to mediation or small claims or wherever it's going to be heading after that, that you have a very solid basis for the cancellation. So let's go ahead and get started. So um, first, we just have some graphs here of the typical contingencies in the purchase contract. So these are all the defaults. You can see pretty much everything is at 17 days by default for the contingencies. Um, I like to move these around a little bit. I don't like to leave everything at 17 days. I don't necessarily even agree that they were all defaulted to 17 days after, a few revisions back. I think it was a 2022 revision of the RPA, but this is where it's at. So usually we will see these get adjusted in the contract. There are contractual actions, though, that also have timelines attached, which we need to make sure we're adhering to, on the buyer side to make sure we don't get notice to performs from the seller. And some of those lesser known ones are things like a verification of cash, verification of down payment, pre-approval or pre-qualification letter. You'll see that in our paperless pipeline, when you go to turn in your file, that that is a requirement, and that is because it's actually part of the contract of the RPA. So that you are either attaching by default, you're attaching your verification of down payment, which is your proof of funds, or your pre-approval or pre-qual letter. Those are by default attached, but can be provided, the other timeline is 3 days. So that is actually part of the contract, and the seller could send you a notice to perform for not providing those within the allotted time in the contract. And this would be a notice to perform for a contractual obligation. Um, Accepting leases and liens, you can see we have some other stuff in here. And then seller contractual actions, same thing, a buyer can send a seller a notice to perform for not um, performing on their part of the transaction as well. And this is over in the end section of the grid, where the seller has contractual obligations as well. And pretty much the longest one is going to be 7 days. And this is mostly for providing seller disclosures over to the buyer. So, um, what do we have last? That's about it in those that I'm going to go over. So if you want a copy of this, we'll put it in with the recording in the Facebook group if you want to take a look at the breakdown of how all the timelines work in the purchase contract. So, all right, so let's go ahead and get into ways that a buyer can cancel a purchase contract. And we're looking for um, solid cancellations. Something that if challenged, the buyer would have a good chance of having a favorable outcome. So we'll start off with, does a contingency give a buyer unlimited right to cancel? And I like to start with this one because this seems to be um, a bit of a misconception that, hey, during the first 17 days, the buyer can cancel for whatever reason they want. And it is sort of true, but it still needs to be done in uh, by adhering to the contract. So, but this is an unlimited right to cancel. So, no, it's important to understand that a contingency does not give a buyer a unlimited right to cancel for any reason at all. Where the buyer, for example, cancels on the basis of an inspection contingency, the reason for canceling must be related to a matter pertaining to the condition of the property and must be in good faith. Indeed, whenever a buyer cancels on the basis of any contingency, the reason for the cancellation must relate to that contingency and must be in good faith. And that is something that I always stress when you're calling me with the questions on can the buyer? Yes, but it must be in good faith all the time. And that's where the challenge can come in from the listing side, from the seller. If they feel that this cancellation was not done in good faith. So we'll dig into that a little bit more as we go. And actually, as a reminder, if you have questions on anything, go ahead and throw them into the chat and I will answer those as we go along. Let me go ahead and open up the chat there. So, um, okay. So additionally, a buyer cannot use his or own contingency to fail. This is, in fact, one definition of acting in bad faith. So an example, if the buyer makes no effort to provide the lender with the proper information required for a loan, the buyer will not be able to obtain the loan. If the buyer then cancels on a basis of the loan contingency, this would likely be a breach since the buyer's own action caused the contingency to fail. This would be both a breach of the contract's requirement in paragraph 8A that the buyer make a diligent effort to obtain the designated loan and use of a contingency in bad faith. So what we're looking at, Section 8 of the RPA here, and it says buyer shall act diligently and in good faith to obtain the designated loan. So, you know, you don't want to ever give your buyer that, well, hey, just don't turn in your documents and then you'll get a fail on the loan. And then we'll just use that to cancel based on the loan contingency because maybe you've already released your investigation contingencies and you're looking for a way out. This would not be the way out. This would be acting in bad faith, and a breach of the contract as far as 8A goes, 8A1. So, lastly, buyer cannot cancel on the basis of contingency if the contingency has been satisfied. Example, the buyer has removed all contingencies with the exception of the loan contingency. Suppose a lender approves a loan that the buyer was seeking, but the buyer chooses not to accept it. Can the buyer cancel on the basis of the loan contingency? Answer would be no. The buyer actually was able to obtain the loan, and therefore the contingency has been satisfied. The buyer's cancellation would be a breach. So in the event of a breach, let's take this example right here, and maybe the buyer's like, well, I want to go ahead and cancel anyways. This is something that the seller could challenge and probably dispute the earnest money. So it's really not going to get the buyer very far, in my opinion, to do something like this. So this is why we need to educate them about contingencies while we're moving along through the RPA and making sure we're doing a good job of not only releasing them, but we're releasing them when they need to be released. Um, and I preface that with not necessarily with the contract timeline. Yes, we want to stay with the contract timeline, but more importantly, we want the buyer to be ready to release that contingency before they do so and not just do it because the date is up. So we need to, walk that line there. Under what circumstances may a buyer cancel based upon an appraisal contingency? The RPA states that the contract is contingent upon a written appraisal by a licensed or certified appraiser of the property at no less than the purchase price, or lower if indicated in paragraph 3L2, which you can put down here as well. If the property doesn't appraise at the purchase price, then the buyer may cancel based upon this appraisal contingency, and the buyer would be entitled to the return of the earnest money deposit. Good faith generally doesn't come into play here since the buyer has little control over the appraiser or the appraisal process. If the appraisal comes in low, the buyer simply has a right to cancel. However, if the buyer did improperly influence the appraiser to obtain a low appraisal, in order that the buyer might cancel, this could qualify as bad faith on the part of the buyer, in addition to violating other laws. In such circumstances, the buyer's cancellation would likely be a breach. So let me see here. 1 second here. Okay. All right, next up. Under what circumstances may a buyer cancel based upon the loan contingency? So um, I see a lot of contracts come through, and we look through, especially through the grid section, to help with the um, the checklist so that we can narrow down the checklist to, be exactly what is needed for the transaction. Under the RPA specifically states that the buyer shall act diligently and in good faith to obtain the designated loan. Again, that's paragraph 8A we just went over to. Example, the buyer is obtaining a conventional loan not to exceed 5.5 fixed rate and not to exceed 1 point. So this is what that would look like in the grid section. Typically what I see is just the loan amount in here. I don't usually see the rate or the points to obtain that specific rate. And that's what that is. You're saying the buyer is willing to pay up to 1 point to obtain this rate of 5.5%. And it's already defaulted to conventional financing. So let's talk about adding in these two extra pieces that I don't usually see, which is the rate and the point. So if the buyer, after making a good faith and diligent effort to obtain such a loan, is not approved, then the buyer may cancel the agreement without being held in breach of contract. What does it mean in the context to make a good faith and diligent effort? The answer is not always going to be clear. However, an example of a possible bad faith would be if the buyer has not provided a complete loan application after being asked for one, or if the buyer has intentionally failed to provide requested documents to the lender, or perhaps the buyer told the lender falsely that they had lost their job. If the buyer engaged in any of those actions, then cancellation based on a loan contingency may be a breach of contract. And this is something that a seller can dispute. Another example of a failure to act diligently and in good faith to obtain the designated loan is where they never sought to obtain a loan at 5.5%. Let's say the buyer only sought out loans at 4.5%. Clearly, then the buyer could not cancel on the basis of the loan contingency because they never made an effort at all to obtain the designated loan, which was a conventional 90% loan to value, 5.5, no more than 1 point. So when you do that, that is your loan contingency that you have created. That's the terms of the loan contingency. Should the financing section indicating the interest rate and points be filled out? I get this question sometimes, but like I said, most of the contracts I see come through do not have that filled out. It's just the loan amount and then the type of loan. So it's an important part of the loan contingency for the buyer making good faith and diligent effort to obtain the designated loans. This protects the buyer by making it clear exactly what type of loan the buyer should try to obtain. When the contract is specific, then the buyer will be able to cancel with greater confidence if they're unable to obtain the loan. If the section is left blank, then it will be unclear when the buyer may use the loan contingency to cancel. Does it mean that the buyer must take any loan they are offered, no matter how bad, in order to cancel on the basis of the loan contingency? Or does it mean the buyer need only to make a diligent effort to obtain any reasonably priced loan? It's unclear, and the failure to fill out the section can lead to unnecessary disputes. The most recent revisions in the RPA do not require the buyer to fill in the section regarding points. Merely by leaving it blank, the buyer is indicating that the loan they are seeking will be with 0 points. So this is why, it is good to fill out the interest rate. How do you know what the interest rate is going to be? Well, more than likely, the pre-approval letter has the interest rate on there. That's typically what you're going to see. If you don't, you may want to have a conversation with the lender on what interest rate they're looking at right now. And then you would use that in your loan contingency. If the buyer is offered a loan on the terms as designated in RPA, but then objects to other terms such as a prepayment penalty, can the buyer cancel? So the answer depends. In the case of Robertson versus Dodson, a judge stated that when an agreement to sell real property is silent on the details of the terms of financing, the usual and standard terms of a note and deed and trust must be accepted by the buyer. Specifically, in that case, the judge stated that the buyer had no right to reject a loan on the basis that the note contained an acceleration clause. However, the judge speculated that the buyer might be able to reject a note on the basis of compound interest, since that custom or usage was not well known in the community, in quotes. So the answer here is that it may be possible for a buyer to reject finance because of certain terms, but then cancel on the basis of a loan contingency if the terms are not common terms of a typical mortgage. But it is not clear what terms might fit in with that definition. The buyer would like to reject a loan based on certain provisions, such as a prepayment penalty, and then cancel on the basis of a loan contingency, the agent should advise them to speak to an attorney. Um, so I guess it doesn't answer a question too much, but you can see where it can start to get into a little bit of a gray area with the loans. And so being more specific on the terms of the loan would be in the buyer's favor to be able to cancel more easily or more firmly with the seller and hopefully not get into a dispute. So what is the rule for cancellation based on an inspection contingency? So um, this is a good one to go over because, like I said, there's a pretty good misconception out there that you can just cancel for whatever reason for 17 days. So let's go over that. The inspection contingency is the broadest contingency. As outlined in paragraph 12 of the RPA, it includes a wide range of types of inspections. Additionally, the incorporation of the buyer's inspection advisory into paragraph 12 further broadens the scope of the inspection contingency. And why do we ask for the BIA, the buyer inspection advisory on our checklist? And you can see that it is incorporated into the transaction. So yes, we do need that signed by the buyer as well. So here's section 12, and you can see this is probably the biggest section in the RPA, and there's a ton of ways that they can cancel, yes, but again, it's all got to be in good faith. So, if someone gets into escrow and maybe they deposit their earnest money, and then 5, 6 days later, they're like, you know what, we want to cancel, and they haven't done any inspections. They haven't given you a reason other than we just don't like the house now. That's probably going to get challenged by a seller. So, if especially without doing inspections and things like that. You'd have to give some, you know, you don't have to give a reason, but you should have some reasons of why you're canceling. So, what makes the inspection contingency especially broad is that both the law and the contract give the buyer a wide latitude to exercise the inspection contingency based upon a good faith assessment of the condition and any other matter affecting the property. And so that part right there is where it gets pretty broad because there are a lot of reasons that a buyer can cancel aside from just investigation findings from a home inspection, a termite inspection, plumbing, electrical, whatever you're doing. Case law expands the buyer's rights even further by allowing the buyer may exercise the contingency and cancel the contract based upon the buyer's own subjective standard of which conditions are satisfactory and which are not. Nonetheless, there is still the limiting factor that any buyer decision to cancel must always be in good faith. And so that's the part where, you really need to be um, acting in good faith when you're making these cancellations without having done any investigations or anything else yet. And so meaning that the buyer's reason for cancellation must be genuinely be based on either the condition of the property or some other matter affecting the property. Um, so can we get some specific examples of what might constitute a proper reason for canceling under an inspection contingency? So as discussed above, the buyer can cancel based upon an inspection contingency for any reason in which they are truly dissatisfied. There are many possible reasons for cancellation, including pest inspection that comes back indicating Section 1 woodwork must be done, or where the Megan's Law database shows a sex offender living nearby, or the roof needs repair work. So, there is a broad spectrum of reasons that they can cancel, but again, it should be in good faith and I guess believable. So, especially to the seller. Practice pointer. So, if at all possible, the buyer should not rely upon a single factor as the reason for canceling under the inspection contingency. Generally, most buyers have more than one reason for not liking a property. And in the cases that discuss the inspection contingencies mentioned a multiplicity of factors That must be considered when evaluating a broad inspection contingency. So it is best for the buyer to not focus on any one single factor as the basis of their dissatisfaction. However, if there's clearly a single overriding factor, then the buyer's cancellation will still be proper as long as the buyer is genuinely and acting in good faith. Is the buyer required to specifically state the reason for the cancellation at the time of the cancellation? And this is no. This question comes up fairly often of what do I put in the cancellation for the reason? And this is basically how you're going to fill out that cancellation. So you're not required to give a specific reason. Nowhere in the contract or the law is the buyer required to immediately state the exact reasons they are canceling. Therefore, if the buyer wishes to cancel on the basis of an inspection contingency, then the buyer can indicate as the reason for canceling paragraph 8 and 14 of the RPA, which reference the buyer's right to cancel without going into specifics. So we are looking at section 1 of the cancellation of contract form. And if you're canceling with the investigations contingency based on any of the inspection findings, um, you would be using it would look like this. The party that is canceling is the buyer. They are in section 1A1 as permitted by the good faith exercise of paragraphs 8 and 14 of the agreement. You can see how many times in the contract they talk about good faith. So, and that's the part where things get challenged. So, obviously, you're going to want to be armed with a reason. You're probably going to be asked for that reason. You may need to give that reason in order for the seller to agree to sign section 2 of the cancellation and release the earnest money and not dispute the cancellation. Ultimately, however, the buyer should have his or her reasons. If there is a dispute over the deposit, then a mediator, arbitrator, or judge may demand to know why the buyer canceled, and the buyer should then be able to fully explain his or her reasons. So you don't have to put the reasons in the cancellation, but you need to be ready to have the reasons. Is a buyer guaranteed to get the deposit back when he or she properly canceled the contract in good faith based on the contingencies? Um, when you're speaking with your buyers, and especially with first-time buyers, because they're putting up 3, 4, 5, 10 grand, in earnest money deposit, and they don't want to lose that money, and we don't want them to lose that money either. So we want to make sure that when we're explaining this, we don't want to say, oh, well, you can cancel for any reason and you'll get your money back. Um, that is that language right there can get you in some hot water with your clients because it takes both parties to release the earnest money on the cancellation form. Escrow is not going to do it without both signatures, at least any reputable escrow company that I know of. So keep in mind that if there is a dispute over the deposit, there is a good chance that a judge in small claims court or an arbitrator will make the determination as to who is in the right and who is in the wrong. Small claim court judges are not necessarily knowledgeable about real property or contract law, and even if they are, they might not care to strictly adhere to the law, either depending on their sympathies or the particular facts of the case. Also, it's quite possible that a judge might decide that the buyer's reasons are in fact in bad faith simply because the judge does not believe the buyer's testimony. So, um, in practice, do not provide assurances to your client that they will receive the deposit back. I like to always say that they're entitled to it, or they may be entitled to it, which is also how it, reads in the contracts and forms. So whether it happens, they might be entitled to it, but the seller may still disagree and not release the earnest money. Maybe they're mad. Well, they're probably mad. And some of them think that they're in the right, even though they might not be Maybe that's the first time they've sold a home in California. They sold up in other states and it worked differently in other states or whatever, whatever they've heard. And so they might think that they're entitled to it because maybe a buyer has passed a timeline or something like that. That's not how it works in California. So, um, again, we are trying to make these as bulletproof as possible so that should the seller dispute the buyer's cancellation and should it go to mediation arbitration, uh, anything worse than that, that our clients have a good leg to stand on. So we want to explain this to them properly in the beginning because I've had agents call me and say the buyers are canceling. They're upset because it's been 3 days and they don't have their earnest money back yet and they want to write an offer on this other house. And this was the agent rushing through the cancellation and not explaining it to them properly to understand that cancellations can take time. Usually, you know, I see usually at least a week from the time cancellation is initiated, by the time you get both signatures from both the buyer and seller, by the time the escrow instructions come through, which also requires buyer and seller signature again, and then releasing the earnest money back to the buyer. So it is generally not a fast process. I would say it's definitely in the, you know, 3 to 5 business days um, category of time. So you may explain that under the terms of the contract, the buyer has broad inspection contingency rights, pointing to paragraph 8C that states the contract is contingent upon the buyer's acceptance of the condition of and any other matter affecting the property. And see paragraph 12. But ultimately, if there is a dispute, a judge or arbitrator may decide the issue, and no one can ever guarantee how any particular case will be decided. Uh, One only has to look at many high profile court cases to see that decisions do not always go the way expected. I'm gonna check the chat here real quick, just to make sure we don't have anything. Okay, looks like we might have one. So Manny had an example. He had a buyer cancel because they saw some homeboys, in quotes, hanging out across the street from the PIQ over the weekend. There was no evidence of gang type people living on the street until this event. The husband worked nights and the wife would be home alone with their little kids. We issued a cancellation right after EMD went into escrow. Seller must have known because there was no objection. I know this session is about buyers canceling, but what are the seller's obligation to disclose this type of situation when the visual objection is a lifestyle objection? So I guess it depends on how frequently that would be. If we went on a tangent here, if this is something that happens overnight, or every night or every weekend, and it's a nuisance, then it does need to be disclosed, actually. You will notice uh, in the seller disclosures TDS SPQ, it asks about neighborhood nuisances. And is that something that is that serious to disclose? Potentially, that, hey, there's, whatever, a restaurant or a bar or a gas station or something at the corner that gets a lot of activity in the evenings and there's been some incidents there. Can you refer them to, the crime map or something like that? Yes, you can. But on the seller side, yes, there was a case a while back that I heard about where there was one of the neighbors had a kid who constantly was breaking into cars, breaking into houses um, along their street, and just a menace essentially. And seller did not disclose it on the sale. And this was a repetitive thing that was just happening like all the time or in waves. And the buyers sued that seller actually and won that case because the seller didn't disclose that there was a neighborhood nuisance in there, which was a kid that was ravaging the neighborhood essentially. So Um, to answer your question, Manny, I don't know. Was it that bad or was it not that bad? Was it just a preference of the buyer? They didn't want to have anything like that happening, or was this, a recurring nuisance? All right, liquidated damages. We're just going to go over some basics real quick. Um, what is a liquidated damages provision? So a liquidated damages provision is an agreement in advance that in the event the buyer breaches contract, the buyer will owe a specific amount of money. Example, if the agreed deposit amount is $5,000, which is placed into escrow, and the liquidated damages provision is initialed by both buyer and seller, then if the buyer breaches contract, the seller will be entitled to $5,000. Um, and again, you see it says entitled, doesn't say will get, because again, it's going to take two parties to release that money. So if the buyer is disputing it, saying, I'm not in breach here and I'm not going to sign section 2 of the cancellation, then now you got a dispute. So, um, so you're going to want to explain that when you're on the listing side. It does not matter whether the seller has incurred an actual loss that is either more or less than 5,000. That is the whole purpose of the provision, is to set the amount damages in advance so that it is not necessary to prove actual loss. And there's, a couple um, trains of thought on the liquidated damages provision. Um, I know some brokers out there teach that, hey, don't initial that when you're on the listing side because we want them to be able to prove their damages. Um, Others say sign off the liquidated damages provision, move on. I'm going to let you decide on what you want to do. I err on the side of signing the liquidated damages because it does make the cancellation go a little faster. Um, and just generally, it ends a little better. Otherwise, you have to prove what the damages are. And so you're almost immediately moving past, uh, you know, any sort of quick resolution to the cancellation. Because now the seller is going to come up with a laundry list of stuff and how much it costs them. And I'm sure it's going to be overly inflated. And that's obviously not going to sit well with the buyer. So I tend to always sign off on the liquidated damages provision, but you can do as you please. What is the advantage of a liquidated damages provision to the buyer? For the buyer, the main advantage of the liquidated damages provision is certainty. If the clause is part of the contract, the buyer knows in advance the maximum amount of money that he or she will owe to the seller in the event of a breach. If the amount of the deposit is 5,000, then that is the maximum the buyer will owe. A low deposit amount, therefore, usually work to the advantage of the buyer. Could a seller collect monetary damages from a buyer for breaching a real property purchase contract that did not contain a liquidated damages clause? And that is yes. The fact that a real property purchase contract does not contain a liquidated damages clause does not mean that the buyer could escape liability for failing to perform. It simply means that the amount of damages the seller could recover would not have been pre-negotiated, and therefore the seller will have to establish in court or arbitration the amount of his or her actual monetary injury. And again, that number could be high. So if you're working on the buyer side, um, you know, you want to negotiate your earnest money amounts properly in favor of the buyer, enough to get the deal done, um, and probably sign the liquidated damages provision, depending on, kind of how this purchase is going to go. And sometimes you may not want to. Um, I think we have a couple chats here. Isn't it deposit actually paid or up to 3% of the selling price? We'll cover that in just a second. So Establishing the financial loss resulting from a breach of contract can be a complex and expensive process, and it may require the presentation of evidence in court or arbitration. Generally, a seller will need the assistance of an attorney to properly calculate the actual damages he or she has sustained in a failed real estate transaction. So again, if we're trying to get this property sold, this may not be the best route for everybody by not having the liquidated damages. Given the benefits of liquidated damages provision, shouldn't buyers and sellers always insist on one? And again, not necessarily. A liquidated damages provision is an estimate of the damages a seller might be entitled to in the event a buyer were to breach a contract. This estimate could differ significantly from actual damages ultimately suffered by the seller. Example, assume that a buyer's deposit was $5,000, but the actual financial loss to the seller when that buyer wrongfully failed to perform ended up being $10,000. In this case, a liquidated damages clause fixing the seller's recovery at $5,000 will likely preclude the seller from recovering the full actual loss. Here, the seller might regret having agreed to liquidated damages. On the other hand, assume that the actual financial loss to the seller ended up being only $1,000. In this case, a liquidated damages clause could result in the buyer losing more than the seller's actual damages, and the buyer might regret having agreed to the liquidated damages. So what side are you representing? What's the purchase price of the home and all this stuff? What's the seller going to be doing? Is this a contingent sale, where the seller is buying another property? And if this one, if a buyer breaches this sale here, it's going to damage their other purchase as well. Well, if you're on the listing side, you want to make sure that you have an adequate um, earnest money amount in there and the liquidated damages um, provision initialed in that event so they can move on swiftly, but it's already predetermined that they're going to get X amount of money for their damages, which, could be, um, maybe they're making payments on two houses. I mean, there could be a ton of things. So you really want to assess the liquidated damages if you should be using it on that particular purchase and also the earnest money, what amount should you have to cover seller's potential loss in the event of a buyer breach? Should a realtor advise a client whether or not to agree to liquidated damages? No, as illustrated in the previous question, the decision to agree or not agree to a liquidated damages provision may depend on a combination of legal and economic factors, along with the client's own personal concerns. Though many realtor clients decide and agree to liquidated damages clauses, a client with questions regarding such a clause should consider discussing with an attorney and not AI, like an attorney. How much is the liquidated damages? Car purchase agreement says that it is the amount of the deposit actually paid. Thus, if the agreed upon amount of the deposit was $10,000, but the buyer only put $5,000 into escrow, then the liquidated damages amount would be $5,000. Um, is a liquidated damages amount always 3%? And it's not. It's only the amount that is actually paid into escrow. However, where the buyer will take occupancy of a residential dwelling up to 4 units, then per the terms of the RPA, the liquidated damages amount can be no more than 3%. So hopefully that answers your question, Sonia. Thus, even though the deposit actually placed into escrow might be 50,000 on a 1 million property, the liquidated damages will be no more than 30,000, paragraph 29 of the RPA. Also, if less than 3% of purchase price is agreed amount of the deposit that is placed into escrow, the seller is still limited to collecting in damages only the agreed upon amount of the deposit and cannot later try and get additional funds. So if 3% of the purchase price would have been $10,000, but in the contract, the parties agreed to a $3,000 deposit. The seller's limit to $3,000, even if 10,000 is placed into escrow. Is it possible to have a liquidated damages provision greater than 3% in residential sales? It's possible. However, where the buyer is to take occupancy on a 1-to-4 residential sale, the RPA does not permit this by the terms of the contract. Paragraph 29 of the RPA states liquidated damages will be no more than 3% of the purchase price. If the buyer is not taking occupancy or the property is not a residential 1-to-4, then the liquidated damages amount may be greater than 3%. So, like I said, hopefully that answers your question. It's dependent on occupancy and if it's a 1-to-4 unit sale. Does liquidated damages clause automatically entitle the seller to the buyer's deposit if the transaction does not close? That answer is no. This is the last. No, we have a little bit left. Liquidated damages clause only determines the amount of money a seller can recover from a buyer, and then only if the seller can prove that the buyer breached the contract. A buyer may fail to close a transaction for a variety of acceptable reasons. Example, where the buyer's obligation to purchase contingent on the buyer obtaining financing, and the buyer could not reasonably obtain financing. To recover liquidated damages, the seller generally must prove in court or arbitration that the buyer's failure to close was a breach. A limited exception exists for certain sales of subdivision interest regulated by California's Subdivided Lands Act. A subdivider's contract may include a procedure whereby an escrow holder is authorized to release a buyer's deposit to the subdivider pursuant to a liquidated damage clause if the subdivider provides a specified notice to the escrow holder and buyer declaring the buyer to be in default, and the buyer does not object to the subdivider's notice. That's not going to happen very often. Is a non-refundable, hold on, I think we have a couple chats. A couple. So in a declining market, would damages be the difference between that sales price and the future sales price if the seller cannot sell the property for the amount they had the home in escrow for a wrongful buyer? Again, it depends on how much money was put into escrow and if the liquidated damages clause was provided. So if you only had a $5,000 earnest money deposit in there and the damages clause was initialed by both buyer and seller, then that's the max that the seller can get, even though they may have suffered far more from that because it's declining market and now they can sell the home for, only $10,000 less or maybe even worse than what they had with that first offer. And we see that happen from time to time. That's why we really try, to avoid homes going back on the market. Another question, what if both parties do not come to an agreement on inspection findings or credits to buyer? Then the buyer should cancel. There is absolutely no obligation for the seller to offer credits to a buyer or agree on inspection findings because every single purchase per the RPA in California is an as-is purchase. So the terms that you come to after your offer and your counter offers and all of that, that is the agreed upon purchase terms. Anything beyond that is going to be a request to modify the agreement. And that's why, we went over addendums versus amendments a while back, because that would be an amendment you're making to the contract. So if you have all of your inspections done and the buyer's, trying to negotiate for another 10, 15, 20K in credit, and the seller's just saying no, 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 then the choice is that the buyer can cancel. Otherwise, if you get to the timelines of where the buyer should be releasing their investigations contingency and they have not done so, that is when the seller can then send a notice to perform. And if the buyer still does not, then the seller can go ahead and unilaterally cancel. And that's, what we went over last week. Can the parties agree in advance that the buyer will pay a non-refundable deposit in the event of a breach? Actually, sorry, I missed one. Is a non-refundable deposit clause the same as a liquidated damages clause? No, a non-refundable deposit clause typically provides that the buyer must forfeit his or her deposit to the seller, even if the buyer has a valid reason for not closing the transaction. By comparison, a liquidated damages clause entitles a seller to the buyer's deposit only if the buyer breaches the contract. It can be difficult to draft an enforceable non-refundable deposit clause, and only an attorney should do that. Can the parties agree in advance that the buyer will pay non-refundable deposit in the event of a breach? Generally, no. The law does not permit contracts to impose penalties for forfeitures, including a non-refundable deposit for breach absent gross negligence, willful or fraudulent breach. In general, judges are reluctant to enforce a penalty or forfeiture clauses where they bear no realistic relationship to the actual damages incurred. Additionally, courts have found that any provision in a contract by which money or property would be forfeited without any regard to the actual damage suffered would be an unenforceable penalty. And then the last up, you're at second read. Can a seller ask for the deposit to be released before close as a condition of accepting an extension? And I've gone over this many times. You've probably heard me talk about it. If you're negotiating an extension and you're on the listing side, you're going to want something in exchange for allowing the buyer extra time. And that usually for me boils down to earnest money deposit release or partial earnest money deposit release. So yes, the most common circumstance in which a deposit is released is pursuant to a negotiation for an extension of escrow. At that time, sellers who want the buyer's deposit released in the event of a default may offer an extension. At the same time, it is recommended that the buyer be required to remove all contingencies. The deposit released should be in the amount that was in fact placed into escrow pursuant to the purchase agreement and should be no more than 3%. However, releasing a buyer's deposit to the seller is not the same as allowing the seller to keep that deposit. This would be a very, very, very rare instance. I have not ever experienced it, but it's not 100% guarantee. So do not provide assurances that the seller will retain the deposit under all circumstances, even if released. Where the seller breaches contract, there may be, or where the amount is excessive in retaliation in relation to the amount of the seller's actual loss, or where the seller resells the property and thus reduces their loss, it may still be possible for the buyer to attempt to get their deposit back. So release the deposit to the seller is nothing more than that. It does not guarantee the seller will in fact be able to retain that deposit in all circumstances. And then we have a case here. So this case denied all liquidated damage amount that was part of a court-approved settlement. And then there was another one where the case upheld payment of an additional money as consideration for extending escrow, but the parties were deemed sophisticated. So there is case law with this. I've never seen that happen, but if you have a very savvy buyer, or maybe the buyer felt wronged in this situation, they go to court, it is possible that they can maybe get a portion or all of that awarded back to them through the court. So, like I said, I have not seen that happen, but that possibility is there. So, again, be careful when you're out there making promises about earnest money. So that's all I have for today. Um, let's see, we got one more statement or question from Manny. So, in a multiple offer situation where multiple buyers go over the asking price, wherein the selected buyer has gone above the asking price of uh, gone over the asking price of their own offer, and in a counteroffer situation, the buyer acknowledges that the seller is selecting that specific buyer's offer above all others. Can this be a justified reason for requesting a non-refundable deposit versus going the route of typical liquidated damages? Um, Typically, what I would see in that situation is that the earnest money would be released after a certain time frame in the contract, such as after after the investigations of the property happen and the buyer is ready to move forward, then the earnest money, being released to the seller. But again, you can see where that could be a potential issue down the road. It's a slim chance, but I would usually see it not immediately at open escrow, although it could be, or a portion of it could be, but usually I see it after the buyer has done something, some sort of contractual obligation or pertaining to contingencies usually. Um, all right. So, oh yeah. Sonia, did you want to talk about your listing in Huntington Beach? So I can talk about it real quick. Sonia's got a new listing coming up in Huntington Beach. Um, a bit of an investment opportunity. Home needs a little bit of work. Not too bad. Um, the price, we have the link down here in the chat if you want to take a look at it. Um, or maybe she did get it listed, I guess. So any buyers on Huntington Beach, they're looking for, I think, 1.8 on that house. So it does need a little work. There's going to be some sweat equity in that one. Is it flippable at that price? Potentially. Depends on what you do with the house, I guess. So, all right. Thanks for attending, everybody. And we will not see you next week. Actually, it is a holiday on Monday. So we will have a break week next week. So no Monday meeting. And then we will return the following week. And we won't be going over cancellations. So hopefully you enjoyed the three-part series of cancellations and mastering them. Thank you for attending each of them. And hopefully you learned a little bit because it is an important part of, us representing our clients and being able to perform these properly to protect them and their earnest money, depending on which side you're on. So, hope everybody has a great week, and we will see you in 2 weeks. We'll talk to you later.